Okay, so today we're going to continue our discussion with reference to Chapter 16, which is mutual fund fees and services. So we started out on that, and I'm going to just go through that a little more, little backtracking and covering that again about the fees. So right now, actually, this is more recent. It's not in your course, but in Ontario, the DSE fees are going to be finished in Ontario. It's not allowed anymore. But right now, for your course, you do need to know about that. There is deferred sales charge, which is in your course. You need to know it for the exam. I don't think they changed it right now. So we are going to go through the DSC and the front end fees. The calculations we'll do later. I want to first understand the theory, and then we will do this example and then the other calculations later on also. So we will talk about that later on. So right now, um, first about the fees, I just want to remind you that, okay, let's go back to Scotiabank. So Scotiabank, I'm going to share my screen. If you look at the fund facts, let's take a look at one of the fund facts. And based on the fund facts, you should be able to, okay, let me share screen. Okay, you guys can see my screen, right? Scotiabank. So under the investments, under mutual funds, we said that every mutual fund has fees, nothing is for free. And when you buy a mutual fund, so when you buy and sell mutual funds, there may be a fee. That's one type of fee that we were talking about. That is called, if you pay when you buy, it's called a front end fee. And if you pay when you sell, it's called a deferred sales charge or a back end fee. So here under the, let's take a look at the dividend fund, for example, right? So under the dividend fund, let me open up the fund profile. So under the fund profile, we saw here that, for example, MER, the MER is the management expense ratio. So 1.74%. This amount you will be paying annually. That is annual percentage, right? So we calculated if you invested $10,000, how much does it work out to be on an annual basis? What is 1.74% of 10,000? Yes, anybody? How much is that annually in one on an investment of 10,000? Yes.
$174.
Yes, perfect. So 174 on $10,000, that is your annual fee for it. Okay, and it seems not a lot. It's okay, but it does eat into your return, right? So if you're, it depends on what return you're getting. If you're getting only 1 point, that's 1 month, sorry, 1 year. Let's look at 1 year. 22% you're getting. If you got that, that's great, right? So then, so what you're, so it means on $10,000 you made $2,279. It went up. But on this, so this is after the minusing the MER. So they already minus the fee from this amount here, from this increase. So all the returns here, which are indicated, are all after deduction of MER. So all the mutual funds have MER, and in the MER, we were discussing about that in the MER there are different things. So we're going to go through detail. What are the breakdown of the fees in the MER? So that's one thing to keep in mind. The second is the load. As you can see here, no load. Load means if you buy, do you pay a fee? If you sell, do you pay a fee? No load means that there's no fee to buy and no fee to sell the mutual fund. And in the bank, all the mutual funds usually they have no load. Okay, so that is the concept about the load. But in your course, and also you need to know about what are the Sophia? Who is Sophia? Oh, maybe okay. Let me see. When we went out, okay, let me add her. Yes, Bunmi, did you join us, Sophia?
Sorry, the network was bad, so I had to log out and log back in.
Okay, no problem. That's fine. You're
Oh, yeah, my daughter. Sorry.
Okay, that's okay. I was just wondering. It's you. Okay, that's fine. No problem. Welcome back. Thank you. So we're talking about the load, no load structure means that there's no fee when you buy and no fee when you sell. But so in your course, there's front end, there's deferred sales charge. So this a little bit about deferred sales charge here. Some funds charge a fee up to 6% when you sell your units or shares. This is called DSC, deferred sales charge. Defer means later, you pay later when you sell, or back end load. So the longer you hold the fund with a DSC, the less will be charged when you sell it. It's basically an disincentive for you to sell. Like first year could be 6%, second year 5%, third year 4%, 3, 2, 1. And if you hold it for 7 years, see at the end of 7 years, it could be 0%. Okay, so that's one thing. And also, DSC mutual funds allow you to redeem up to 10% of your holdings each year without paying a redemption fee. So if you have $10,000, 10% of 10,000 is what? $1,000. So $1,000 you can take out without any fee. Okay, that's allowed usually. You can do that. So that is allowed, but if you want to take out more, then there would be a fee for that. They basically want you to keep your money in the account, right? Until for long term, over 7 years, and you take out, then they will let you take it out. So that's what we have here. So I just wanted to give you a little background there before we go on. Let me share the slides again now. In your slides, we were talking about this here. Let me share the slides here. Share. Okay. So we were talking about here under the fees, right? So we said that what are the fees? So there is sales charge, which is on buying or selling, and then there's the management fee. Okay, we'll do the calculation later. Don't worry about it for now. And then besides that, so besides those, there's also trailer fees. Trailer fees are annual. Once a year, usually the investment advisors will charge a trailer fee, and that will be that is going to be also charged to the investor. Okay, and then there's so sales fees we already talked about, or load fees, right? And this is redemption fee. That is, like I should just showed you, the deferred sales charge or back end fee. Okay, so this fee is based on the price at the beginning or at the end of the investment. So we'll do the calculation later, but right now understand theory first of all, that these are the fees that you may be charged. And then there's other fees also. There's trustee fees. If you open up a RSP, there can be a fee. If you transfer your money out, there will be a fee because there's a cost and time effort for the company if you need to transfer out your money. And then, so this is what does the investor pay for? So the investor pays for operating expenses, management fees, and sales charges. So these both are in the MER. So MER is management expense ratio, like we saw the example of the equity fund, 1.74%. That is the total of management fees and operating costs paid by a fund, and it is expressed as a percentage of its average net assets. Okay, so that is, every fund has a MER. And trading expense ratio, this is also shown in the fund facts, and that is also, that is extra to the MER. So that is also trading expense ratios mainly for equity funds. Those which are in shares or stocks, they will have a trading expense ratio. Okay, so that's where we stopped last time. Just wanted to go through that also. The next section is about how you can deposit money into mutual funds or take out money. So one, of course, obviously you can do a lump sum. You can put money in 10,000 one time, or you can say I want to put in $1,000 every month over 10 months. You can do that also. So that's also known as pre-authorized investment plan. Pre-authorized, just like we have pre-authorized payments for our bills, you can set it up that automatically it will take the money from your checking account and put it into the mutual fund automatically. Okay, so there's two things, benefits. One is investment discipline. Like if you say I'll do it myself, you might say, ah, forget it, I don't have the money, or I'll spend it somewhere else. I'll order stuff from Amazon and I won't do it. So it's investment discipline. It goes there automatically every month. And the other benefit is dollar cost averaging. So I'll explain dollar cost averaging here. But this is basically better. Of course, it's in discipline, irregular savings is there. Dollar cost averaging means that by investing a certain dollar amount, not trying to time the market. Sometimes people, they say, oh, now it's going up, now it's too expensive. The price of the unit is 16, 17, 19, 20. I'm not going to invest, it's too expensive. Or it may be coming down. It's coming down, it's 15, 13, it's 11, it's 10, and you're going to say, oh, it's going down, I'm not going to invest. So, or some people, they will go ahead and they'll say, now it's cheaper, I'm going to buy. Or I'm going to, so that's called timing the market. Some people, they wait and think I can get a good price if I time the market. But that's not always a good idea. It's better just put it in every month, and that is, you get the benefit of dollar cost averaging. The dollar cost averaging says that over the long run, your average cost will be lower, because when the price is going down, you're buying more units for the same dollar. When the price is higher, you're buying less dollars, less number of shares. So that is dollar cost averaging. Let me show you that in the book also. If we look at the book, the concept of dollar cost averaging. So here's the textbook. So systematic. So this is in your. So let me make that bigger. Zoom it to 125. Yeah. So we're in chapter 16, and this is systematic withdrawal. We're talking about accumulation. Here's dollar cost averaging. So in this example here, yes, what they're showing you here is that in January, so this is January to December 1 year. This person actually, yeah. So this person actually, there's two clients, client A and client B. Client A says, I'm going to put in 6,000 here in June and 6,000 in December, 2 times. The price of the units is increasing. Usually it will increase. Hopefully it could go down, but let's assume it's going up. And it won't be going up exactly this amount all the time, but it's just an example. 10 cents every month it's going up. 10, 10, 10, 20, 10, 30. So the price is going up 10 cents every month. He puts it in June and he puts it in December. He puts in 12,000. Now, how many number of units does he get? If you do it on your calculator, 6,000 divided by 10.50. He puts in $6,000 and 1 unit is $10.50. He will get 571.43 units. Right? Clear? Same thing here. Now here, 6,000 units and the price is 11.10. So 6,000 divided by 11.10, you'll get 540 units here. If you add these two up together, he will get 1,111 units and 97. This is the number of units he will get on $12,000 investment. Now the other client, she says, okay, I'm going to invest 12,000, but I'm going to do $1,000 every month. So the benefit of doing that way is, you see, when the price is $10, she's buying 100 units. When the price is 10.10, if you do 1,000 divided by 10.10, you'll get 99.01. So every month now, as the price is going up, the number of units purchased is going down. So when you add this all up, this person is going to get 1,138 units. So for the same price, this person is going to get more units, and their average price is lower also. So both things are, beneficial for this client by doing dollar cost averaging, but that is only if the price is going up. If the price is going down, then it's opposite. But usually we expect the share price to go up over time, right? So this is the concept of dollar cost averaging. Any question about dollar cost averaging? Okay, clear? All right, let's go on. Okay, I think I should have gone. Anyway, so okay, in the book, so there's systematic, that was deposit. You can deposit 2 ways: pre-authorized automatically, or you can just do lump sum. It's up to you, right? So now we're going to talk about systematic withdrawal plan. Systematic withdrawal plan is how to take money out. So you can, as we remember, anytime the market is opened, you can sell your mutual funds, right? So when you sell your mutual funds, you can take your money out regularly. It's not logged in. Remember, it's called open. It's called that it is open-ended fund, and as long as the business day is open and it's not a holiday, you can in cash and you can get your money usually after 2 business days. Systematic withdrawal is you can instruct the company that I need to take out a certain amount every year or every month. They can set that up, right? So there's 5 types of systematic withdrawal plans. There's fixed dollar, ratio, fixed period, life, and annuity. So we'll talk about those here. So fixed dollar from the name obviously means I need to take out $1,000 a month, regardless what happens. So they probably have like 100,000 in their account. So $1,000 a month, $12,000 a year, no matter what. It depends then again on the price of the mutual fund when they take it out. But based on that, that is a regular fixed dollar amount. Okay. Ratio withdrawal means that they're taking out a fixed percentage, like say suppose 20% annually. He wants to take out 20% every year. That is a ratio withdrawal plan. Okay. And then fixed period withdrawal says that I want to take out my money and I want my money to be finished in 10 years. So that's an example, or 5 years. If a person is retired at age 65, they think I'm good if I get this money, if it lasts me till age 75. So they may want it to go out for, keep coming out till for the next 10 years. So then you divide the money over 10 years. So that is a fixed period withdrawal, right? Here you may end up taking out more money and then having trouble later on. Life withdrawal plan is depending on the age. Now you can estimate based on Canadian standard what is your life expectancy. Usually it's like 85 for female and around 83 for male. So you can plan that accordingly, and so people can do that based on life withdrawal plan, right? And then annuity is that is another way you can put money into an annuity where it is through a life insurance company. The annuitant is going to get a certain amount of money as long as they are alive. When they die, then the payments stop. That's annuity. So these are 5 types of withdrawal plans. So let's take a look at those 5 types here in your textbook also. Here they give you examples, easy to understand. So here's systematic withdrawal plans. For the fixed dollar, you have $100,000. You should be able to do percentages easily. What is 10% of 100,000? It is going to be $10,000, right? So you're going to take out $10,000. But let's suppose after 1 year, it's worth 10%, right? So 10% is 110,000. It's gone up by 10%. So 110,000. This is on January 1st. This is on December 31st. And then you minus 10,000, so you're back to 10,000, 100,000. And then next year it may go down. Your mutual fund, as we said, you saw it fluctuates. It may go down. If it goes down 5%, so now this is worth now 95,000 and 95,000, and now you're taking out 10,000. So 85,000 is there, and then it goes up 14%. So are you guys okay to calculate this increase of 14% and a decrease of 5%? Are you guys okay in that math?
You just minus it from the beginning number, right?
Yes, I mean on your calculator you're able to do that, right? You know how to do minus 5% from here?
Yeah, just take the 100,000 minus 5%, and you'll
Yes.
get the value, and you just
Right.
minus it, and you get 95K.
Yes, that's right. Yeah, but me, you're okay with that?
Yes.
Good. Okay, that's great. Yes, and Brenna, you too, right? So
And
so
if there's no minus sign, then you just add it, right?
Mm-hmm.
Okay.
Yes. So, like sometimes they may give you a question like this. You start out with 100,000, and he wants to take out this, and this is the return he got. What is the value at the end of the 3rd year? So you need to do these calculation up till the 3rd year. Yes.
So you have to go through 1, 2, 3, 4. So say if this happens, like say if you have that chart right there, and they say you have to do the calculation for what is the calculation for the 10th year. So then how would you do that?
Usually they won't go that long. You're just probably 3-4 years. They probably ask. They won't go that long.
So let's say
do
if you
each
want
one.
it for like the 8th year, how would you do it for the 8th year then?
So you have to keep going on. They'll give you percentage earned. So so it's 76. So here, let's take a look at here. Like if you have this number
Also, then
here,
they'll give you the end of the year, or they give you the percentage earned.
they'll
So
give
you
you
can
the
just go
percentage
by
earned.
that.
Yes. Yeah, they'll
Okay.
just give you percentage earned and how much you start out with. Like here, you see it's 73,865. So you
Mhm.
minus 10,000. So you're left with how much? 63,865.
Yeah,
Right?
and then you add the
Add
20%.
20%. You this and then minus
Okay.
10,000. So next year is going to be 66,638.
Okay, so it's like for the 5th year, right? It's going to be 20% of the 63,865, right?
That's right. Yes, 20% of this is added because it's increased.
Yeah.
And
Mm-hmm.
then you minus the 10,000 at
And then
the
you
end.
minus 10,000, and that's going to come the
Okay.
next year.
All right.
Okay, so here it'd be 66,638 in the 6th year starting amount, right? Okay, good. And then ratio withdrawal is same thing. Only thing here, instead of fixed amount, you're going to withdraw a fixed percentage, right? So here you're taking out 12%. So whatever this amount here, you got 91,960 on December 31st in that year times 12%. And then so you're going to be taking out $11,035.20. That is the amount you're taking out, right? And then so you take this and minus this amount, you're left with 80,924. So same way, only thing difference here is a percentage. You have to calculate what is 12% of this, what is 12% of this, what is 12% of this. In the previous one, it was just 10,000 is minus, 10,000 is minus, 10,000 is minus. Right? Clear? Fixed period withdrawal is you're going to say it's a 5 year, so they want to finish their money in 5 years. So the way you'll do it is you'll do 1 divided by 5 in the first year, then 1 divided by 4, then 1 divided by 3, 1 divided by 2, 1 divided by 1. That's the ratio. So if you do that on your calculator, actually 1 divided by 5 is 0.2. That is 20%. So you really need to take out 20%. If you do 1 over 4, that's 25%. You're taking out 25% of this. Then you're taking out 33%, 33.33%. Then you're taking out 50% of the money. And then you're taking it all out. And that way you're at the end is going to be 0. At the last year, you're going to take this amount, the full amount out, and it's gone. Clear?
Yes, sir. I don't understand this one. So, okay, you take out 1 over 5 of 110, and that's going to be 22,000. Then you subtract it. Okay.
Okay, let me show you on the calculator. So on the calculator, let me stop share and let me share this calculator here. Okay, so you see my calculator?
Yeah.
So we had 110,000. Okay, now the ratio we need to take out is 1/5. 1/5 is 20%. Or if you do even times 1 divided by 5, so it will give you 20%. 20% is $22,000.
Yeah.
So that is the amount we're going to take out from the 110, right? So if you take this and you just make it a minus and you add it to 110, so you're going to be left with 88,000.
Okay.
Right? And then the next year, you're going to be, they have the next figure. So that's just how you do it every time.
So the next year is going to be 1 over 4?
Yes, 1 over 4. And see, yes, so you should know 1 divided by 4 means 25%. Yes, and then 1 over 3 means it's going to be 33.33%.
All right. Okay.
And you're
right?
taking
And
that
1 over 2 is going to
the,
be 50%. Yes, sorry.
and you're taking that over from the balance left or the beginning balance.
So you're going to take it over the Here, see here, so you're going to take it based on the ending value.
Ending balance, okay.
Right, 25% of the ending value. Here you're going to take out 33% of the ending value. We're always calculating this rate of withdrawal on the ending value. Same thing we did here, 12% of this ending value. Here we did $10,000 of the ending value, right? So that is always based on that. Like, well, this is just a minus. This is going to minus 10,000 from the ending value. Here it's going to be 12% of the ending value. Here it's going to be this ratio of the ending value.
So you do 110,000 minus that from 1 divided by 5, right?
Do it on your calculator. What do you get? Do you get 22,000?
Yes.
10,000 minus that by 1 divided by 5. Hold on. So wait, 110,000 minus 1 divided by 5?
Mm-hmm.
110,000 minus that from 1 divided by 5 equals, I got 109. What the
No,
hell?
you're not doing it right. No, you're not. So listen, you have to do one. So you see here what I did in the calculator. I did 110 times 1 divided by 5.
Oh yes, 110 times 1 divided by 5. Okay, yes. Okay, I got it.
Or
just-
you could
I'll
do,
click-
you could also, if you do it on your calculator, 1 divided by 5 is equal to 0.2, right?
Mm-hmm.
1 divided by 5 is equal to 0.2. Then 0.2 multiplied by that will give you $22,000.
Yeah.
that's
So what?
okay.
Yeah. So what I didn't understand was, we subtract the 22 from the 110, we get 88,000, right?
Yes, yes,
So
that's
where
right.
does the 83,600 come into play?
We took, so there were, in this year, it went down 5%.
Okay.
So we're minusing 5% from here and
Oh,
end
okay.
up with this. In other words, you're doing, so one way of doing this, a trick way you can do is 95%, right? We have 95% left.
Mhm.
So you could do what is 95% of
Of
this,
88,000.
and
Okay.
that is what you should come up with.
So now it's going to be 1/4 of the 83,600.
That's right, yes.
Okay.
Exactly,
Okay.
yes.
Thank you.
Yes, good. Yeah, right? Brenna, you're okay?
Yes, I am.
All right, good. All right. Okay, let's go on. So the life expectancy is the same thing here. Same as the ratio one. The ratio one, we said 5 years. We're going to start with 1/5. The life withdrawal is, we're going to say 1 out of 20. This guy thinks he's going to live for 20 years. He's, let's suppose 65. He thinks he's going to die at 85. So he has a 20-year period. So we're just simply going to start out with 120, then go 119, 118, 117, 116, etc., going on till for 20 years. So that gives us the ratio. Whatever is the ending value of the mutual fund, that amount will be taken out. So he's going to get roughly 5,000, 6,000 roughly amount every year from his investment, depending on the ending value. And that way it will finish in 20 years. So by the time he finishes, his mutual fund will finish too, right? Clear? So it's the same as the ratio withdrawal. Only thing is we're just using like the years, more years. Okay, clear? And then annuity, simply, we're not going to go into detail about annuity, the whole story there, but basically you just get a payment from the annuity from life insurance companies. Okay, so let's go back to taxation. So the next section is about how are mutual funds taxed, right? So let's take a look at that. So first of all, we said there's 3 types of income you can get, right? So as you probably remember, hopefully, one is interest income, second is dividend income, and third is capital gain, right? So the company, so when you have an investment with any mutual fund company, any bank, they will send you a T3 or a T5 slip. Just like you remember when we have our job, we get a T4 slip, right? The T4 slip has boxes, it has information in it. This is your salary, this is EI deduction, this is CPP deduction, blah, blah, blah. All that stuff is in there. Same thing on the T3 form. It will have a form, and it will say on it, you have so much interest income, you have so much dividend, you have so much capital gain. T3 is sent for a trust account, and T5 is sent for a corporation mutual fund. Remember, we said most of the funds in Canada are trusts, so mostly you'll get T3 form. And simply when you do your taxes, you have to give that T3 form or T4 form to your accountant, and they will enter the information into the boxes on your tax return. This is for a non-registered account again. A non-registered account that is not the RSP. For RSP, you don't get any T3 or T5. You only pay taxes when you withdraw. TFSA, no taxes on the withdrawal. We'll talk about taxation more in your chapter 6, but basically for any registered account, you do not get any T3 or T5 slip. This is only for mutual funds held outside of a registered plan, right? Only for those ones we are talking about, that we are going to be putting it. If it's, then you get that. So any income you get, it is passed on to the unit holder, but capital losses are not passed on. So if the fund gets a capital loss, like we said, you don't pay any taxes on that. It's just basically you lost money. That's it. You don't pay taxes on money that you lost, right? If you have a rental property and it was empty and you had to pay money to pay the bills, you don't pay taxes on that. It's just you just like don't have to pay anything, right? You just lost money, simple as that. So same thing here, capital loss is not passed on. Clear so far? So at the end of the year, you should be careful to buy a mutual fund at the end of the year. Any capital gain triggered with the tax during the year is going to be taxed. So if you buy a mutual fund in December, you may get a capital gain, and you're going to have to pay taxes on the full year capital gain. So that's not recommended to buy a mutual fund at the end of the year. Usually, it's not a good idea. So we're going to talk about adjusting the cost base. Yes, I'm going to show you about distributions again. So when funds are reinvested, the investor owns more units worth less NAVPS. And so when you get, so the distribution, remember what are we talking about? Adjusting the cost basis means that when you get your distribution from the mutual fund, which is like your bonus, you need to keep track of that for tax purposes, because you need to adjust the cost basis. So we're going to take a look at that. So when you get your bonus or dividend, you can do one of two things. One is you can take the money and go and spend it, go party, enjoy the money. That's one thing. Second, you can say the company reinvest the distributions. Just take the money and buy me more of the shares or units. So you can do that instead of getting the cash dividends. So that is also possible to do that. And so in this case, the NAVPS is going to fall, meaning the price of the mutual fund will go down. Let's look at this example. Hopefully it makes it clear. If you invest $20,000 in a mutual fund and the company gives you some distribution, some annual income, okay, and later on you sell the mutual fund when it was worth 28,000. So now you got some. So let's suppose this was after a couple of years, and now you got some other income. You got some distribution. Now the capital gain is not 8,000. You're going to say, oh, 28,000 minus 20,000, I got a profit of 8,000. But you don't pay taxes on that 28,000 because you reinvested the funds also. You got some distribution which was reinvested. So let's suppose the reinvested income is $3,500. So 3,500 is going to be call this as the gain you got from your distribution. Okay, so 8,000. We're going to add that to the 8,000. So we're going to do is right. So the cost basis is going to be 13,500, and capital gain would be 4,500. So what we're going to do is we're going to do 8,000 minus the 3,500. We're going to minus this because this has already been paid for. They already paid taxes on this amount, right? So you need to minus that.
Sorry to interrupt. How do you get the 3,500?
Sorry? What did you ask?
Sorry, how do you get the 3,500 from?
Yeah, so this is given, but this is what we're saying is annual. This is a
Oh,
distribution that they got from the mutual fund on an annual basis
I see,
based
I
on
see.
the, this is, think of it as a bonus, think of it as like the dividend that they get from the mutual fund. Okay, so the reinvestment that they did was they took that money and they bought more shares. So 8,000 minus 3,500, when you do that, you will get the difference of 4,500. Okay, clear?
Yeah.
Okay, so that is, so 8,000 minus 3,500 will give you 4,500. Now the cost base is what is my cost for buying the mutual fund, right? So you bought it for 20,000, right? You bought it for 20,000, but you're not going to say that you bought it for 20,000. You're going to say that you actually the cost, the capital gain is going to be, um, so actually it's going to be, okay, sorry, I need to fix that. Actually, that's not correct. 20,000 minus the cost base, 13,500. So it would be 6,000. Okay, sorry, I'm gonna have to fix that. Sorry, let me show you here. Let's go back to the other one. I'm gonna show you in the example here in the mutual fund. Let's take a look at that. I wanna explain it to you through here. Let's go to the, okay, let's take a look at this example here and I'll explain it here. So the distributions here, this is if you buy this Canadian dividend fund, okay, when you buy the Canadian dividend fund, you are entitled to distributions. What is a distribution? That is coming from the mutual fund because the mutual fund has certain profit. Remember, we said all the profit in the mutual fund is passed on to the investor. So if you had this fund in 2016, now let's suppose you held it the whole year in 2016, you did not sell your mutual fund, you would have got $1.89. So $1.89, what is this? This is $1 per unit. Depending on how many units you have, you will get a check for the distribution. Okay, $1.89. Now that $1.89 is going to comprise of two things. Number one, there's a dividend income and there's capital gains income. Okay, the dividends is from why? Because this is an equity mutual fund. It's invested in shares, right? And those shares, so it's invested in TD Bank shares, Royal Bank shares, Scotia Bank shares. So the dividends are going to be issued. Dividends are issued. So there's 59 cents per share that you got dividends. And remember, when you get your T3 slip or you get your T5 slip, it will mention you have got so much dividends. Now, let's suppose you have 100 units. Let's suppose you bought 100 units. How much distribution will you get from 100 units? Can anyone tell me? 100 units, how much dollar money will you get in 2016? Yes, anyone? If you have one unit, you will get $1.89. If you have 100 units, how much will you get?
That'll be 189.
Yes, that's right. Yes. Simply multiply by 100, right? If
Yeah.
you have one unit, you're going to get $1.89. If you have 100 units, you multiply it by 100, move the decimal over two spaces, you get $189 from distribution, right? And of that $189, $59 is dividends and $130 is capital gain. If you add these two up together, it equals 1.89, right? Clear? Now, the question that we're talking about is, what are you going to do with this? This is your, if you sell your mutual fund, you pay taxes on this. So you're going to have to pay taxes on $1.89. Even though you did not sell the mutual fund, you got the $189. Now, what can you do with that? You can either take the money and you can spend it. It's not a big amount, $189, or you can say to them, I want to buy more shares. Okay. Now, what is the NAV? The NAV is $76.48. Let's suppose this is NAV is actually It's probably going to be different now, but this was the NAV on which date here? It'll show here, April 30th. Okay, so it's $76.48. So for $189, how many units will you get? Can anyone tell me? So it's you get $189 and one unit is worth $76.48. How many units will you get?
What was the question again?
So one unit is, how much is, you tell me, what is the price of one unit?
Mm-hmm.
What is the price of one unit?
76.48.
76.48 is the price of one unit, right? Everybody clear so far?
Mm-hmm.
That's the price of one unit. In 2016, you got $189 distribution. How many units can you buy with 189?
You could get 2.47. Sure.
Yeah, that's right. 2.47. Yes. So $189 divided by 76.48. Yes. Everyone following me?
Yeah.
So you can get 2.47 extra units from that distribution. Clear?
Yep.
So now what we're saying is that but you still have to pay taxes on the $189. So,
but not if you transfer it to your tax-free saving account.
That's a different story. No, even if you do that, you still have to pay taxes on it because you can, whatever you do with it, you still have to pay taxes because this money has not been taxed. The distribution is given to the unit holder. Whether you receive the funds, you put it in your RSP, you put it in your TFSA, you reinvest it, you still have to pay taxes on it. Okay. So you do need to pay taxes. How much, that's a different story, but some taxes need to be paid on it. So what you need to do is, we're saying, is you need to adjust your cost basis. When you sell your fund, you need to report that so if you got let's suppose you got a capital gain of, let's suppose, I'm going to make it easy, $2,189, you made a profit. You're going to say, I already paid taxes on 189, so I'm going to adjust my cost basis. So that's what we're saying in that concept there, that we are going to adjust the cost basis accordingly. That is, if we are going to sell, if we're going to have a distribution, we are going to adjust the cost basis. That is what we're talking about here. Okay, so so that's the purpose here that you need to understand. Okay, so yes, okay. So let me go back there to the slides. So we'll do the calculation later on. I just want you to understand again the concept here. And we'll go through this again, but this is what we're saying here. Distributions, interest, dividend, capital gain are taxed to the unit holder every year. And dividends are taxed whether they are reinvested or not. So you have to pay taxes on this anyways. And dividend or capital gain will increase the ACB. So you have to add it to the ACB. Okay. So we'll do this calculation later on. Right now, just keep this in mind that you do need to add it. You need to adjust your cost basis. I think we'll go through this later on in the chapter 6. But this is the summary. Adjusted cost base is equal to original cost plus reinvested dividends. So if you reinvest the dividends, you need to add that to original cost. Remember in that example that we did? So 8,000 plus the 3,500, we need to add those two together, and that will be your ACB. That is going to be your adjusted cost basis. And the capital gain is equal to proceeds on sale, how much money you got on sale, minus the ACB. And taxable capital gain, that is going to be whatever the capital gain is, you multiply by 50%. Capital gain only taxed at 50%. So we'll do this. I mean, I'm going to leave this for later. We'll do the calculations later. But right now, what we're saying is it is a little complicated. So that's one of the negative things about mutual funds, that the taxation is a little tricky. So you need to understand that. But I mean, technically, let me show here the T3 and T5 slip. I mean, simply for an investor, what they're going to get is a T3 slip. Okay, the T3 slip is going to look like this. It's going to be yes, this is a T3 slip with some numbers in it. Yeah, this one here. So the T3 slip is just going to show you, this is the, yeah, here we go. T3 slip, it's going to show you on the boxes. As you can see, it has a box for eligible dividends. How much is the dividends you got? It has dividend tax credit, how much you're eligible for, capital gains, how much you got. Okay, and then also interest income will be there. So the T3 is a statement of trust income allocations. At the year end, you will get this from your bank or from the investment company, and you need to then deposit that along with your other T4 and other slips you got. Clear? Right? Okay. So that is what we're talking about here. Let's go on to the next chapter. Any question on this? Okay, next chapter we're going to go through is mutual fund dealer regulation. Here we're going to talk about the different regulations for mutual funds. Some of them we already mentioned a little bit. So let me share screen. Okay, mutual fund dealer regulation, chapter 17. So what are the mandate and scope of securities administrators? So disclosure, enforcement, registration, three things. These are three very important points under securities administrator. What is security administrator? So in Ontario, we have OSC, Ontario Securities Commission. And by disclosure, we mean that the client has to be informed about what they're buying. They have to be disclosed. So what is the disclosure? Disclosure example is fun facts. What are you going to give the client? You're going to give a fun fact. And in the fun fact, all the information is disclosed to the client, right? There's enforcement. If you go on the OSC website, you will see disciplinary actions against individuals and against companies. If there is any dispute, any complaint, they will investigate it. If somebody does wrongdoing, they will be prosecuted. So enforcement is also there through the securities administrator. And then there's registration. That's why you're doing this course. You need to do the IFIC. You need to know these products. So it's not just about passing the products. You need to know this stuff, because when you talk to clients, you should not give them the wrong information. And once you pass the exam, you need to register. You need to be competent to be registered. In other words, there should not be no bankruptcy, no criminal record. There should not be other issues like that. And then you need to get registration through Mutual Fund Dealer Association, and then you will be licensed for dealing with the public. So the securities administrator, they manage all these three things. They make sure that these three things are enforced. Clear? So they issue policy statements also. So we said there are some different policies. The three main types of policies is provincial, national, and uniform. So the provincial policies are usually in one province. As you know, a lot of Quebec has different rules. Every province has their different rules. And so the securities administrators, there's different ones in each province. Alberta has its own, Nova Scotia has its own. And so these are particular to the individual province. The national instruments and national policies, these are all of Canada. There are some rules which are followed by all over Canada. Those are the national policies or national instruments. And then there are uniform policies. These are only in BC, Alberta, Saskatchewan, Manitoba, Ontario. Only these provinces, they have what is called uniform policies. Okay, so those are the three things you need to keep in mind. So what are the self-regulatory organizations? The main one you will deal with is Mutual Fund Dealers Association. It is a regulatory, self-regulatory organization in Canada. They have the right to regulate mutual fund dealers. So MFDA mainly is concerned with how are mutual funds distributed to the public, how are they advertised, right, and how are they dealing with clients. So MFDA does not cover customer losses due to market values or unsuitable investments, or if a mutual fund or a manager defaults. That is not, MFDA does not cover that. But there is coverage, which we'll talk about later about MF. There is a coverage which is called CIPF. That is up to $1 million. That is if they have with the company which is CIPF registered. So we'll talk about that later. So what is MFDA? MFDA has the power to analyze and monitor complaints, investigate violations, disciplinary actions, impose fines. So it is like a policeman. They have the rights to cancel registration, to investigate, right? So we said there's national instruments. There's National Instrument 103 is one example. The 103 provides that each mutual fund dealer must maintain a compliance system that provides assurance that the dealer and the individuals are following the regulation. So as a mutual fund dealer, you must follow all the rules of the Securities Commission and also the company you work with, their rules also. Otherwise, then you could be in trouble and the company could be in trouble. MFTA rule number 2, business conduct. So this is generally, there's, if you read through that, there's a rule, it's on the internet also, you can read it in MFTA website. Of course, need to deal fairly with clients in good faith, observe high standards of ethics, don't engage in business that is detrimental to public interest, and be of such character and business repute, and have such experience and training as is consistent with standards. So business conduct is also, of course, important. And in Quebec, they have their own rules. They don't use MFDA, they use AMF. They have their own organization. Okay, so that is AMF. And the branch compliance officer, each branch or office of MFDA dealer is required to have a person responsible for compliance, right? So that BCO is also, so every branch has a BCO officer. It may be the branch manager, it may be someone else who will review all the trades every day. Whatever trades you do, they will review the files to make sure it's compliant. And then there's also a head office a compliance officer also, right? So that is also a part of it. So what are the registration requirements? So before you do registration, you need to also, of course, so okay, sorry. So this is before registration. What can an individual do? If you're not registered, what can you do? You can receive a redemption request. If somebody says, I want to sell my mutual fund, you can take the form from them for selling and provide it to the mutual fund dealer. That is allowed. Okay. You may receive a completed order form and forward it to the registering salesperson. So if somebody drops off a form at the branch, I want to buy a mutual fund, and they fill it out, you can receive that. You can provide basic information. If they ask, how much money is in my account? Can you give me a my statement? Or what is how much money do I have in my mutual fund account? You can just provide the basic information. You can provide how many number of units they have, what is the capital gain or income they got. So you can't, so the advice or recommendation of mutual funds, you cannot hand out the mutual fund document or prospectus. You cannot give any advice to clients. You cannot hand out any order form, or you cannot assist them with completing the forms, right? So so that is not allowed. So You cannot do those things though, right? So this is so only redemptions you're allowed to do, but you cannot give advice on buying or selling the mutual funds. So in order to be registered, you must pass the education qualifications, of course, either IFIC or CSC. And then there's a training program you have to go through 90 days from the start. And you must be closely supervised for 6 months. Of course, you pass the exam and you notify the results of the exam and you file your registration and fees. Usually there's some fees for the registration. Usually most companies will cover the fee. And then to remain registered dealing rep, you must pay an annual fee also at a specified time frame. And if the individual is not registered within 3 years of successful completion of the exam, you must again pass the exam. So your exam is only good for 3 years. If you don't get registered within 3 years, then you must redo your exam. Okay, so those are the requirements. And if there's any changes, for example, you change your name or you change your address or you change anything related to your application that you filled in, you have 5 business days to inform the administrator. If you transfer a branch, usually the branches will inform them. If you move to another company, usually the companies will inform them. But if you change something, if you work somewhere else, then you have to inform them, of course. And if it is more than 6 months, then you have to reapply for registration. And if you transfer to another province, then you need to get new registration in that province also. So this is also, of course, requirement for registration. National Registration Database. This is a website. You can go on the NRD website. That is the website on which the registration is filed electronically. So usually you need to fill out an application form with all your 5 years history, where you lived, where you worked, etc. And you provide that to the company and they will register your information on NRD website. And so you can only be sponsored through a single mutual fund company, right? And you're not permitted to carry on any other forms of employment without prior approval of appropriate securities administrators and SROs, of which firms are members. So basically, for the NRD, you need to fill out the registration application, setting out all your detail about where you worked, employment, conduct, any criminal record, and this and that. And they may do a credit check also. So that is through the NRD website. That is for all of Canada. Dual employment. So if you become mutual fund licensed, you can also get your life insurance license. So that is allowed. You can do that. You have to inform, of course, Securities Commission, and you need to, of course, it must be with the same company, or your dealing rep must be aware of it and approve it. And there's requirements that you need to keep the 2 businesses separate. And if you have any other outside business or any other job, you must inform the MFDA or the company, and you must inform them that this other activity, what it is, and get approval. It should not be something which is disrespectful or, other things which is going to be giving a negative impression of you or the company. So that is dual employment is allowed, but it is restricted only to certain activities which are not giving a bad image. Okay, clear? Any questions so far? So now we're talking about KYC. KYC rules are, of course, very important. We will talk more detail about that in chapter 4, also getting to know the client. But here it is mainly, before you are going to take a client, you must collect information about the client, right? Learn their essential facts, because you should not give advice until you know about the client, you understand them. Make sure that it is within their best interest to invest their money in the mutual fund, and what is their purpose, Is it short term? Is it long term? Is it for retirement? Is it for what is the purpose? What is the risk tolerance? And what is the time horizon? All those things, which we'll talk about in chapter 4. And then only you can give the suitable recommendation. If and you need to know about the products also. Both things. You must know about the product. You must know about the client, and then you can give the suitable recommendation. So if you have an unsuitable, unsolicited order, then you should consult your branch manager. So if you, what is an unsolicited order? Yes, anybody want to tell me what is an unsolicited order and a solicited order? Anybody
Is
have
it
a?
unsuitable, unsolicited? Like the funds are not suitable for the client. Like either they're like maybe more risk and they take, I mean, less risk and then they take like more risk funds.
Yes. Mm-hmm.
Yeah.
Right. Yes. Good. So that's if it's if they say my risk is very low, and they come to the branch, if they bring a check for $10,000, and they say I want to invest in the dividend fund, and the dividend fund is a medium risk, and they say I'm a very low risk person, I don't want to lose any of my money, and I want to invest in the dividend fund, so that is unsuitable, and they came and they gave you the request. That's an unsolicited order. They did not, they heard from their friend or their family member, oh, I invest in the dividend fund, it did really good, and I want to invest in it. That is an unsolicited order. A solicited order is when you, as the MFDA, MFR, you are going to talk to the client, understand their needs, and then you give them recommendation. This is what you should be investing in, and they accept your recommendation. That is a solicited order. Unsolicited is just they come out and they ask you for the order. It's just an order, and so it may be unsuitable for them. If it is unsuitable, you need to consult with your branch manager or branch compliance officer, and there may be written procedures on this, and you are in no obligation to accept it, because later on if they buy that mutual fund and they lose money, they're going to say, oh, you didn't tell me I could lose my money, this is a high risk one, this is, I lost my money there, I told you I don't want to lose money. So there will be a conflict, right? So you do not have to accept any unsolicited unsuitable order. Clear? And then, of course, there's anti-money laundering, anti-terrorist financing. You have to make sure the money is not coming from any illegitimate source. What is the source of funds? You have to find that out. You have to find out if there's a financial interest in the account. If somebody's uncle is, for example, outside of Canada, and they send them money and they say, invest this for me in Canada, that's a third party type of financial interest. So if there is a third party person, then investment experience and knowledge of that person also should be included in the KYC, and there should be mentioned that this is a account open for the benefit of somebody else, right? And how do representatives satisfy this? So changes in circumstances. So if there's any changes in circumstances, the client must be aware of that. Okay, sorry. Yeah, so judgments used to determine whether KYC has been obtained should be updated at least once a year. Usually once a year you see you have usually, like when I was in the branches, I had like 500 clients. So you should contact them once a year at least. Once a year you contact the clients. How's everything going? Any changes? Have you any changes to their situation? They got a new job or their risk tolerance. So you should be updating the KYC on an annual basis at least, or whenever they do a trade. And dealer must request in writing that each client notify of any material changes in circumstances. So if there is any changes, they should inform that also, right? So this also is very important. Okay, so the next section is about opening the mutual fund account. So we'll talk about that next. Let's take a short break. So it's 8:05. Let's take a 5-10 minute break, 5-6 minutes. Just take a small break and we'll come back. Okay. Let me stop recording.
All right, thank